All right, this is the last part, part 5 for chapter 3. So let's get right to it. Number 4, the fourth thing that we're going to be looking at is accrued revenues, okay? And this is an instance where we've earned some sort of revenue, meaning we've done what we needed to do, but we haven't been paid yet, and we probably haven't billed our customer for it yet. Because if we billed them, we would see a bill, and we would know what to bill them. Remember, an accrual is something and an adjustment is something that we do at the end of the period right before we put out our financial statements to make sure that our financial statements are accurate. So we've got to kind of get up, walk around and ask the managers and the people that are actually doing the work and say, have you been working on any projects that we haven't issued a bill for yet or that we haven't been paid for yet, so that I can go ahead and record the revenues and update our financials. That's really what these accruals and adjustments are all about, is getting our financial statements or getting our general ledger and accounts updated and adjusted properly so that when we issue our financial statements, they are accurate. So accrued revenues, let's jump right into an example here. Remember, it's when we've completed a job, but we haven't billed a person yet. So we in the accounting department would know nothing about it, right? If the attorneys are out there working on a case, but they haven't issued a bill to anyone or some way told us in the accounting department, we wouldn't know. Or if we're still working with the fast forward example, right, which is the consulting service, if they go out and consult for a customer and don't issue a bill or don't create some sort of a source document that would signal to us that a transaction has taken place, we wouldn't know about it. So we have to go get out there and ask them right before we put out our financial statements. So in this example, our company, Fast Forward, agrees to render consulting services under a 30-day fixed fee contract. So we're going to consult for the next 30 days for a client, okay? Next continuous 30 days. It's going to be $2,700 or $90 per day if you divide that $2,700 by the 30 days. But we're going to get $2,700 for it beginning on December 12th, 2011. Now, all services are to be paid, or completed by January 10th, and the client will pay in full at the end once we have completed the 30 days of consulting. But we're going to start December 12th, go 30 days all the way till January 10th. So, and I've used these numbers specifically so that we can have 20 days of consulting in 2011. So, let's start with December 31st, okay? As of December 31st, we haven't collected a dime, but we will have completed 20 consulting days, right? December 12th all the way through December 31st, we would have been consulting our client. But we haven't issued a bill, and he's not going to pay us until January 10th of 2012. So have we earned any revenue as of December 31st? The answer is, of course, yes. And what would the journal entry be to show that, right? Well, first, we're not getting any cash, right? We won't get cash until January 10th. Instead, our client owes us, as of December 31st, for 20 days worth of work, right? So we just multiply out 20 times 90 to figure out what that is. But when our client owes us, that would be an account receivable debit. And the credit side is, of course, revenue equal to the exact same amount. So this is what the journal entry would look like, right? Accounts receivable showing that our client owes us $1,800, 20 days at $90 per day. And we've earned that revenue of $20 or $90 per day for 20 days, so $1,800. Now this is what it would look like when we post it. This, of course, we're going to learn in the next chapter how which accounts are temporary accounts, like revenue and expenses are temporary accounts, and everything else, assets and liabilities and owner's equity, are permanent accounts, meaning those remain with us every year, whereas revenue and expenses are temporary accounts, and they're closed out every period. And the reason we do that is because we don't want to double count revenue or double count expenses, right? Revenue and expenses show you how your company has performed over a specific period of time. More on that in just a little bit, but for now, let's just keep in mind that revenue and expenses are temporary accounts, and we'll have an account for each year. So a revenue account for 2011, a new revenue account will start off for 2012, and we'll get rid of the revenue from 2011. But this account receivable will remain with us until our customer either pays this $1,800 that he owes us or defaults and is not going to pay us, right? Or we find out in some way he's not going to pay us. But don't worry about that. For now, let's assume all of our customers are good paying and will never default. So we keep this account receivable until our customer actually pays us the $1,800. So this is the accrual, right? This is the adjusting entry that we're going to do right before we put out our financial statements. We've earned revenue, but we haven't sent a bill or collected any money. We need to go ahead and write that down. So let's take a look when we fast forward into the future and see when we do finally get paid on January 10th, what's going to happen at that point. Remember, accruals, it's the adjusting entry first, then the business transaction happens later. Usually the cash transaction happens later. All right, so on January 10th, 2012, we complete our obligation and we've consulted for 30 days for that client, and the client pays us the $2,700 in cash. Again, let's start with the easy part. Our company is getting cash, so we're going to debit cash for $2,700. Now, the other side is a little bit more challenging, right? That $2,700, why did we get that, right? Think about that. So some of it we earned in 2011, right? And we already recorded that amount as revenue, so we don't want to double count that as revenue. Part of that $2,700 is because our client owed us $1,800 from last year, right? That account receivable that we set up. So we need to, he no longer owes us that $1,800, and so we need to show a reduction in that account receivable. An account receivable is an asset. So how do we show a reduction of that account receivable for $1,800? Very simple, correct. We credit the account receivable for $1,800. Now there will be a difference, of course, right? The debit of $2,700 versus a credit of $1,800. That's a difference of $900. And that $900 difference is, of course, the revenue that we earned in 2012. So that will go to revenue. This is what that journal entry looks like. And I'm putting up the posting of those amounts as well. So we're going to debit our cash account $2,700 when we receive the cash on January 10th. We're going to credit the accounts receivable to show that our client no longer owes us the $1,800 from what we earned last year. And we're going to credit revenue for $900 for the 10 days at $90 a day that we earned in 2012. And I'm sorry, that should say 2012. I got to correct that slide. Oh, I'm sorry, and I did want to comment just a little bit on that account receivable account, what it looks like now after we post that to the general ledger. You see, once we post that $1,800 to the accounts receivable, the balance will, of course, be zero, right? There was an $1,800 debit. We've credited $1,800. Subtract those out and we get zero, which shows accurately that our customer no longer owes us anything, right? That's what our client owes us, is $0. And that's it, folks. That is all that there is to adjustments and accrued expenses. What I do want to show you now, obviously this is very important for preparing accurate financial statements. If you do not do proper adjustments and accruals, your financial statements, when you prepare them, will be misstated. You'll be lying and possibly breaking some laws if you do not correct them. So really important. So in the last semester, we learned how to do a trial balance, which was really an unadjusted trial balance. In other words, you'll see business transactions throughout the period and you record journal entries. Then you post those journal entries to the general ledger accounts. And then, of course, you write out all your ledger accounts here and you put in the final balance, debit balances, credit balances for each account. Remember, only the ending balances, and you have to have your totals. These are unadjusted, right? We haven't done the adjustments and accruals. The next step, of course, is once we do the adjustments and accruals, which we went through some of these, right? These accounts receivable and all these adjustments that we did before, you would put those in here as well. And you put them into the adjustments column. You would then do the same thing we do before in order to find balances, right? Well, we had a debit balance. Well, in cash, there's nothing. But in supplies, there is a debit balance here, and there's also one adjustment, right? And hopefully you guys think back to, I think it was part 2 that we went over supplies, right? We purchased $9,720 of supplies. That was the balance. Then we sent our minion into the supply closet to count what was there. It showed that we had used 1,050, so the final balance in our supplies account is $8,670 worth of supplies. This gives us our adjusted trial balance, which is basically ready to become our financial statements. And I'll show you what I mean by that. We literally take those numbers and use them from our adjusted trial balance. Here it is, those same numbers from our adjusted trial balance, and use them to create our financial statement. So let's do so. The bottom ones, the revenues and the expenses, are what make up our income statement, right? It's simply revenues minus your total expenses, which are just totaled up right over here, gives you a net income. Remember, if this is a negative number, meaning your expenses are greater than your, then we would have a net loss, of course. But in this case, we don't. We've got $8,150 of revenues, and we've got $4,365 of expenses. So we've got a net income of $3,785. And we're going to use those numbers, this net income or net loss, in our next financial statement. They are all interrelated. So remember, that net income or a loss will increase or decrease the owner's equity. So in this example in 2011, it's our first year of operation, so we had no equity. That's the beginning balance. But we went out and made some net income, so we owe our owners $3,785. We didn't go over this transaction, but it was gone over in the book that our owner invested $30,000, so you would add that. That's again, increase in his equity, and increase in owner equity is net income as well. So our total owner equity is, or investments and revenue, is $33,785. We also had a withdrawal by our owner of $200. So subtract that out, and that's our total capital. And I'll show you what I mean. If we back up just one slide, you'll see that our owner invested $30,000. You can see this in the trial balance, and that he withdrew $200 from the company. So we would just be inputting those numbers. Remember, we've already input the revenue and expenses into the income statement. We're just moving up the line now and taking the capital, or owner capital and owner withdrawals, and the net income number to create that second financial statement, which is the statement of owner's equity. Right? We're taking the net income, the investment by the owner, and the withdrawals by the owner. The rest are just subtotals and adding them. We're then going to take that amount, and I'm putting that statement of owner's equity once again. I'm replicating that for you here. And I've put a portion of the trial balance, the part that we haven't seen here. The cash, this is the assets from cash to accumulated depreciation, and the liabilities. Remember that this is an asset, the accumulated depreciation. It's the sister account to the equipment account, and it is a contra asset, so it has a normal credit balance, unlike the other assets which we learned in this class. Okay, so what we're taking here for the last and final financial statement that we are going to focus on is the balance sheet. And all that is the total of your assets. Remember the plant assets, which are those large tangible assets, long-term assets that we use in our business, are put on our financial statements or shown on our financial statements both at their cost, their original cost, minus their accumulated depreciation from the sister account that they have. And that subtotal is your assets minus your accumulated depreciation amount. That is your book value. So it's shown at a book value. So if you just add up all the assets, this is the total that you come up to. You would then simply list your liabilities. And these numbers are coming straight from the trial balance, right? Just moving them straight over. It's rote process of just copying these things over. Your liabilities are also coming straight from over here. Your accounts payable, your salaries payable, unearned revenue. That's your total liabilities, and then you're just taking the total owner equity from your last statement. And of course, your total liabilities and equity must equal your total assets. And that's it, folks. Those are your financial statements, and that's the end of Chapter 3. Good luck with the homework. Send me a message if you have any difficulties. This is the hardest chapter, so expect a challenge. Good luck.